it happened. We got to the phase of the market where risk reward of many assets became unattractive relative to treasuries. So it smells like we might be ahead of a rebalancing time where those more risky assets will have its correction mode. So, what about the most important indexes on the market? That's the one of the things we'll talk about today. And what about the possibility of occurring a recession this year? So these are the voices that are coming from around, and we might be facing it up during this episode. So I'm very glad to host you here, and let's begin our new transmission. All right, and we are at first kicking off with economy view. Let me know whether we are live, as I would check out this a very important element of that everyone is enjoying the transmission. So at first, let's find out what we got right. The history shows stocks have more room to fall. Why? Because whenever there was a interest rate rising, the market has also been following that. But when it started dropping, it also followed that gauge. That's why if we are just in a correction mode during this hiking interest rate phase of Fed um, behavior, we may find that the market is very weak by its correlation to what was back in the past. So when the market and interest rate has peaked, there was normally a time of a inflection where the market started to reverse, not much soon after. So right now, with this rebound rally, we might be just in a midterm of uh, something like a Minsky moment for this for this recent recent years bull market to fade. So that's about one of the forecast recession might be due the way knocking on our door, and if history will be any guide, the S&P 500 will hit a low only after the Fed will stop raising rates in the cycle. That's why if we just imply more downside if the trend holds true. So US equities recently rallied, but it means that we might be somewhere in the vicinity of having a major slump yet. What about next element? Is recession unavoidable? Let's find out what um, conference board has prepared for us. We'll jump right now to economic forecast for the U.S. economy, and we may find out that due to this statement of market analysts, US GDP growth defied expectations in late 2022, but they expect persistently high inflation and rising interest rates to tip the economy into a brief and mild recession starting in Q1 2023. So real US consumer spending began to contract and in the final months of 2022, and they expect this trend to continue over the coming quarters. So also about the GDP, finally, volatility in trade and inventory data that boosted growth in Q4 2022 may unlikely to persist in quarter 1 and will therefore push overall GDP lower. So that's the trajectory made about by Conference Board, and we can also find that real GDP right here may got us to a negative territory. So the market is getting much more spooked about the negative behavior than it was back in a third and fourth quarter. That's why we had this positive momentum. But right now we need to deal with something that is not going along our previous expectations. So these are the elements that we need to weigh. And alongside, we have a problem with that we are still in this interest rate hiking mode, and when market expects that we'll hike even further, it would mean that during this very difficult time on the market, it might be very painful indeed for sentiment of investors. Not only we go through full recession this quarter, but also the market after rebounding may have its another slump downward with the sentiment slump. So that means we might be right now somewhere around market bottoming and for a recession period, and that will be the phase 1 of this phase of a recession, as another wave may come over with this interest rate cut coming eventually to the table, and with this quantitative tightening being extended further. So it's about that section right now. Let's head on to market outlook, and for this one I will jump to the most important chart for now, as we are right now heading on a strong momentum to this trend line that has recently put many traders in a bias that adds only up from here. But it looks like right now on the RSI chart we might be this trend line might be not enough to get us stopped. We may rebound for a while right here, but the probability of heading lower to 3900s will be somewhat desirable in terms of a prior market price action, and that may also bring such more bears to this equation. So SPX right now doesn't look good. Both are running away from the structure, and the most important stop in my view is this 3800. That's still around 6%, 6.5% from here. Let's find out about next element, S&P 500. So biggest drop of 2023. That's why we have seen lately the increase of this market puts coming up. So after Tuesday, those moods has started to shifting from bull to bear to the larger extent. And what about the gold? As recently, if we just jump over to gold chart, gold looks like has been stopping for a while. We are right now building up some power for rebound, but we have just stopped at 200 EMA. Does it enough to stop bears from falling? Right now, we don't have a juxtaposition of with any of remarkable support yet. So it means that EMA solely might be too few to hold up those levels. Yes, on RSI chart, we can find that we are trying to make a rate contraction that may lead to some kind of bounce, but it doesn't mean we are right now in a phase that those rebounds might be sustainable, especially that's not at all pivotal or reversal pattern has been built up. Neither any type of catalyst candle hasn't been visible. So right now, XAU USD is on the way to move lower. But the question I wanted to answer is whether it's a correction or absolute reverse. So back in 2022, we've seen the highest demand for gold in over 10 years. Central banks' demand was the highest in was it 55 years. So consumer demand on the Chinese and Indian side might be expected to improve this year as well. Possible weakening of the dollar along the way in the second, maybe third quarter will be another factor. So that may determine the good fortunes of gold later this year. But right now, we are still dealing with this much more like a bearish momentum than the other. So gold remains right now resilient to the strongest tightening cycle in years anyway. So some analysts claim that $2,000 per ounce is still possible this year. So that's a very strong start of gold, but right now we are correcting this move in order to find out and to try in order to find the right price for this asset. Right now, let's head on to market movers, and we haven't jumped through this section yesterday. That's why I need to go through today much more and diligently. So on Monday we had RBI meeting minutes. On so it was the meeting that also touched a point of further interest rate hikes. ZTW economic sentiment right now is finding out that Germany is heading to better time with a kind of a very nice recovery. So it was mainly unexpected back in October, but right now Germany looks like very solid indeed after that rebound. That's why that's the factor that justifies recent market growth for Germany. Inflation rate out of Canada is dropping and meeting the forecasts. What about S&P Global Manufacturing PMI of US? It's right now heading upwards toward 50. So we might be stopping this contractory phase of market. We are awaiting on the FOMC minutes today at 2 p.m. That's why if you are watching and also trading on US market, you might have it. um, noted that might be an event that may cause an increased volatility on major assets. Inflation rate out of Japan, that's the thing that we might be also watching that may impact the price of JPY currency that recently rebounded out of its previous lows. Also, we have GDP price index from US that will be a very important gauge for Fed and for us at all. If you wanna find out which type of a phase, which phase of the market we currently are, and for Friday, personal income month over month. And right now, let's find out what about earnings calendar. So for this one, this is a very nice graphic that's most anticipated earnings releases on Tuesday. We had Walmart and Coinbase. Where Coinbase has surprised to the downside. Walmart has shown much more resilient data than the growth stock. So right now, that was something that favored much more bulls rather than bulls on the value stock side rather than growth. So revenue has increased, but diluted EPS has slided a little. So that's the quarterly financials. So for January 2023, EPS beat by 12.88%. This was out of October, and that's the thing I wanted to remark. So revenue, yes. So that's revenue expected 158, reported 162. So it was also a positive surprise for that stock. So right now we are heading to sorry, I haven't shown you the data out of Walmart, so you have it once again. So right here you have a revenue, USD, and EPS expected and reported. It's the positive surprises both together. And in the end, we are right now finding out what's happening within Trade Idea. And I have for you kind of interesting, in my view, bet against WTI. So WTI is crude, US crude oil, and right now we are in a much like a horizontal trend rather than the directional. But as we do know, out of the stronger horizon, we are in a downward mode. So back in January of 23, many of retailers was almost certain that the US oil will be heading upwards this year. There was about 90% of traders that were assured that gasoline should rise, but when every time positioning is favoring to that extent one side, and when the sentiment is so bullish in a downtrend mode, it's normally a time for correction, and that's what happened. right here we've rebounded out of this 72.5 points, this congestion area of where we have built back in January, and right now, as we haven't managed to get across previous highs, it means we are right once again getting neckline that is right at 72.7. It will be right now for us a build a road to lower valuations of 64.8. So that's the technical elements that are worth noting. Right now, let's find out about fundamentals. So for this one, let's check this out. WTI crude oil price seasonality is right now where the March is beginning. Is typically very bearish for oil, and the March might be the month that may correct the price of oil even further, especially with that claim that US is able to sell 26 million more barrels from strategic petroleum reserve. So getting back to where we were with our chart, WTI right now after this very strong and extended consolidation that took us around 75 days, might be ahead of another slide downwards, especially after rejecting that many times this 200 EMA line on a daily chart alongside on weekly. And we have changed this congestion box on WTI after 66 days. So as we are right now 75 days within this box, it might be a time for another change. So I do bet that another target for this trade, if we just manage to cross this neckline, will be 64.8. So 64.8 is the target for me when the price will get through this 72.6 around. Also, there's a the last trend line that's expected to be crossed through. So all signs in the sky and earth pointing that we are right now heading into much more heavier recession for oil market, especially with XLE. That's a SPDR select sector fund for energy select sector, and this recent market sandwich on the weekly chart symbolizes for me that we are right now in a high volatility mode where usually takes repolarization of positions inside of the market. So it would mean that bears may swap away those still remaining bulls on the deck. So if I may get it, if I may just make the trade out of it, in my view, the great entrance is right at these levels right here, as we have very strong supply that will be very difficult to get through. But we may get to, for instance, 76.8 on those FOMC minutes event when this volatility will get increased. But for me, for me, this area inside of 76 and 76.8 is the to perfect one to start a short position if you don't have such already. And with my view, this trade will be uh, will be run like here. So I'm taking a bit more risky option with trading this right shoulder to the bottom, but it works like a magnet, literally. So we should get right down here. So my entrance will be right around these levels, and I would find that my stop loss will be most suitable if placed above those recent highs of 77.7. So risk reward ratio in that case is at 6.17, so it's a very decent play indeed. So in my view, that's the proposition of a trade you may consider to take. But as always, remember about managing your possible losses you are available to take, and as always, don't bet more than you afford to lose. And in this video, thank you very much. That's it, and I'm inviting you tomorrow at 8:45 a.m. East time. Thank you and